actually think that Boeing's okay because I think that we're on the verge of the MAX being approved. I don't think it's going to be that much longer. And at that moment, if you want to sell, you can sell. But I think that does matter. I do think that we're not hearing enough about. We're hearing a lot about planes and how safe they are to fly in terms of the illness. They're safe as buildings. And what I would point out is the great thing about a building, and you can go look at what Cisco's doing before you get there in the New York Times today. In a building, you can stop people who are sick, and they're not going to sit next to you. But when you fly, no one is going to stop that sick person from being next to you. And that's what I think that is the biggest fear that people have in flying. So I'm not a big fan. I mean, the airline stocks have had a major move. I think it would be good to take something off the table on every one of those. Same thing with the cruise ships, by the way. They don't, the cruise ships try to stop people who are sick, but if there are people who get on and they get sick while they're on. I mean, it's just not like a building where you can say, listen, I'm going home. You're on a cruise ship, you're not going home. So these are situations that I hope they solve because I think these are great industries. But in the interim, if you're sick, if you're next to a person who's sick, even if you have the mask and you have the goggles, there's a good chance you're going to get sick. And that's what I think we should have to remember. And that's why flying is down, not just because the business travelers are using Zoom. We have not figured out a way yet to be able to, I know United Arab Emirates is trying to have an up-to-the-moment test, like an actual PCR test that says that you can't get on even though your temperature is fine. That's what we're going to need in order to be able to get flying back to 100%. And that's going to be very hard to get.
If you look at the Fed's balance sheet, it's gone up from 4 trillion to 7 trillion in the space of a few months. So it's expanded its balance sheet. It's lending to pretty much anything it can lend to, plus some more. It's lent to firms. It's lent to municipalities. The Fed has really pulled out all stops. Now, in terms of what it can do more, on the monetary policy side, very little apart from saying, we will not raise interest rates until thus and such criteria are met, and we'll be a little more tolerant on inflation. Perhaps some word on that will come in future meetings, probably not this one. And as far as expanding its balance sheet goes, it's very hard to think of what else it can buy. It's pretty much provided an enormous amount of support, which is why Fed Chairman is saying it's up to the fiscal.
Well, I think you've got three issues that are on the table with fund managers with whom I speak. The first issue is the momentum, which is that broadening of the rally that I talked about before. The second is valuation. And the third is taxes. And those three things, to me, suggest that the market is at the high end of the range at 3,200. And our target for the end of the year, the S&P 500, is around 3,000. And there's more downside than upside as a result. And so if you think about the momentum, clearly that has been the cyclical laggards that have become the darlings at the moment, having moved up a lot in the last couple of weeks. The real drive off the bottom of the bear market was driven, as you just referenced, by the big five stocks, which really powered a good part of the recovery. And then it was transitioned over to the momentum. Now, clearly the momentum has benefited from some of the data on the virus and the medical front. Certainly the economic front, the data has been better than expected, and that's benefited some of the more cyclical related stocks. But I think if you look out longer term, still the technology and some of the more secular growth stocks are of greater attraction. I think the second big issue is valuation. And here's where I have a significant amount of concern. So the market, as you know, is trading at the same level as it was pretty much at the start of the year. But the market multiple, 2 years out, looking at 2021 earnings, is basically gone from around 16.5 to almost 20 times. So we're at an expensive level, certainly relative to history. Even if we adjust for interest rates, we're at sort of an average level at the current expected rate of profitability in 2021.